This video is brought to you in partnership with Stake. If you're in Australia or New Zealand, transfer at least $1,000 worth of Aussie shares across the Stake platform and get 12 months of zero brokerage. Stake rewards, terms and conditions apply. Are we all making a huge mistake buying ETFs now in 2025 with the market at all-time highs? With the S&P 500 touching 6,000 points last month, it's pretty reasonable to think that this could be a really bad time to invest in ETFs that have that market-wide diversification. After all, aren't stocks just really overvalued right now? Should you be waiting for that inevitable dip? These are questions that every investor battles with, and the fear of buying at the wrong time can leave a lot of people completely frozen. So in this video, I want to remove all the emotion and just critically analyze whether it is a smart idea to invest in ETFs, market-wide diversified ETFs at these heightened price levels. And for those that aren't fully aware, I firstly just want to give a little bit of context as to exactly where the market sits as we go into 2025. The S&P 500, which is the collection of the 500 largest stocks in America, will typically rise around 10% in a year. That's the rough long-term historical average annual return since the S&P 500 became the S&P 500 back in 1957. But over the last few years, investors have been treated to some absolutely exceptional returns, 26% in 2023 and 25% in 2024. And as I said, this has now pushed the S&P 500 to around 6,000 points, a level that it's never been close to before. And it's fair to say the market is looking pretty damn expensive at these current levels. For example, a statistic that I quote quite regularly is the Schiller PE ratio, which is kind of like a conservative PE ratio for the S&P 500. And that currently sits at 38, its second highest point in history. This means that investors are willing to pay 38 times the average inflation-adjusted earnings of the S&P 500 from the past 10 years as a price. Historically, this number averages just 17. The Wilshire GDP is another one that's just off the charts. Back in 2001, Warren Buffett said in a Fortune interview that this number, quote, is probably the best single measure of where valuations stand at any given moment, as it divides the total market value of all publicly traded stocks within a country by the country's GDP. Normally, when you get to 100%, you're looking at a very pricey stock market, and currently this number sits at over 200% for America. Then beyond market-wide metrics, we've also seen the meteoric rise of the Magnificent Seven over the past few years, which, thanks to speculative investing behavior, now has these businesses accounting for 33% of the weight of the S&P 500 index. I had a quick look at the PE ranges for these businesses, and they currently sit between 25 at the low end and 110 at the high end. Now that is very abnormal, but looking to Stake's most traded stocks across the past month, you can see this speculation starting to take over, with Tesla, Nvidia, MicroStrategy and Palantir occupying the top 4 spots. I think we can all agree that the evidence is pretty clear. You know, the market objectively is pretty hot right now, and that puts a lot of fear into investors' minds as to whether they should be buying anything at the current time. It's a problem you might be facing watching this video. Many investors hesitate to buy in these markets due to a fear of a correction, and it's something that I've seen play out in my own investing career. But while your brain kind of forces you to think that a correction might be around the corner, statistically, it might not be. For example, when I was first going really deep on properly understanding investing back in 2016, 2017, there was still a lot of chatter around how expensive the market was back then and whether a correction was imminent. Just have a look at some of these headlines from back then. Yahoo Finance, the S&P 500 is historically overvalued. CNBC, any way you look at it, the stock market is overvalued, Goldman Sachs says. And how about this one from Forbes? 4 reasons you should run away from SPY, IVV, VOO, and other S&P 500 ETFs. Well, guess what? Had you run away back then, as Forbes suggested, you would have lost out on some big returns as the S&P 500 continued to power on and on and on through 2018, 2019, only being brought back down by the COVID drop in 2020. You would have missed out on a 20% growth in your wealth if you would listen to the media, although luckily in this case, it wouldn't have punished you too badly if you corrected your mistake at the bottom of the COVID drop. But my point here is that the same thing has been happening across the last few years as well, and it's been relentless. How much spin has the media come out with recently warning us about inflation, interest rates, supply chain disruptions, geopolitical tensions, wars, potential recession, global economic weakness? It's been relentless. If you listen to the media, these issues are set to just rip apart global stock markets. yet the S&P just marches on. And that really leads us to the fundamental underlying question of really this whole argument and this whole video. And the underlying question is, should you be trying to time the market?
I don't know anybody who has ever been successful in timing the market. I don't even know anybody who knows anybody who has ever been successful in timing the market.
Now, I'm obviously no expert, but in my experience at least, timing the market is always a fool's errand. And the reason for this is because markets can stay irrational for very, very long periods of time. The movements of the market quite often go completely against common sense. So while it might make sense now that the S&P's next move should probably be a decent correction and it should go down, who knows whether that's actually going to happen? Even Warren Buffett, literally the world's best investor, has said many times over that he has absolutely no clue which way the market's going to go in the short term.
We haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had. I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market is going to do, or for that matter, on what the economy is going to do. We don't know.
And because of this, investors have come up with a very clever method to still benefit from the market's long-term performance without needing to know when to get in and out. And that strategy is called dollar cost averaging. The idea is simple. Commit to buying a market tracking ETF at regular time intervals, investing the same amount of money each time. This way, when the market is high, your $1,000 or whatever it is naturally buys you less shares. And then when the market is low, the same amount will buy you more. Over time, it evens you out to the market average. And this strategy has been proven to outperform active stock selection many times over. In fact, the Spiva scorecard shows that around the world, the experts that spend all day every day picking stocks almost always underperform the market average that you can get simply by dollar cost averaging. Over the last 10 years, only 15% of actively managed funds beat the S&P 500. It's a strategy that works and is backed up by the numbers. And these days, many stockbrokers are making dollar cost averaging more accessible than ever before. For example, the broker that I use here in Australia, Stake, who are also the sponsor of this video, has recently implemented a recurring investment feature allowing you to set and forget a dollar cost averaging plan with a market tracking ETF suitable to your needs. If you have a Stake account, you can now set up both recurring deposits from your bank account into your brokerage account to make sure you're funding your brokerage account regularly. And you can then set up a recurring investment when you go to buy the ETF that you're looking for to make sure you build that habit and commit to the strategy properly. This is a relatively new feature to Stake, and as you can see on the screen right now, this is me genuinely setting up this process on my own account the other day. I'll also plug that if you're an Australian and you want to join the Stake platform, if you use the code NEWMONEY, you'll also get $10 of free trading credit when you fund your Australian account and a free US stock when you fund a Wall Street account. And if you already have a brokerage account elsewhere, Stake will give you 12 months free brokerage if you transfer your Aussie portfolio over $1,000 in value across to their platform. But long story short, this dollar cost averaging feature is becoming much more popular with brokers around the world, not just Australia. And it's because investors are really starting to wake up to the idea of the long-term wealth building potential of market tracking ETF products and their inbuilt protection against market downturns. Consider the dollar cost averaging example of investing $1,000 into an S&P 500 index fund like SPY every 3 months, but starting at one of the worst times you could have possibly picked, right before the global financial crisis. Literally, your first $1,000 investment was in October 2007, at the tippity top before the global economy went bang. Well, the crazy thing is, because this strategy naturally buys you less shares at market peaks and more shares at market troughs, if you just kept investing $1,000 every 3 months all the way down this brutal decline, interestingly, you only had to make it to January of 2010 before your portfolio was positive. Because the dollar cost averaging strategy naturally buys you more shares low and less shares high, even though you started investing here, you're making money by the time the market has only half recovered. But the more important thing is that now you'd be in the habit of investing that would enable you to capture the more typical market trends that occurred over the following years. So going back to the original question, are we making a big mistake by buying ETFs in 2025? I think now the answer is reasonably clear. The answer is, well, we might be, who knows? But I hope also this video has shown you that if you subscribe to that true long-term passive investing approach, as most people buying ETFs are, then it really doesn't matter. While nobody knows the future of the stock market, people have seen enough to know that the nature of the dollar cost averaging strategy works very well at evening out the bad times while setting you up for the good times. And that's the last point I wanted to discuss in the video. While the media makes us think every year is a bad year to be investing in the market, statistically, the market is much more likely to rise in a given year than fall. Have a look at this chart from First Trust Advisors that shows S&P 500 returns from 1926 to 2019. Now granted, it's not completely up to date, missing the last 5 or 6 years, but it's still a great visual representation of the up and down periods of the market. And yes, every now and again you do get a bit of a negative period, like we got in 2008 there, but on the whole, it's very obvious that the broader market has trended up much more than it has ever trended down, which is a really reassuring statistic for those people that get into the market with a long-term time horizon. That's not to discount the issues that we do face today: elevated interest rates, annoying inflation, geopolitical issues around the world, etc. These factors do definitely exist, and if I was a day trader, I would be pretty nervous to be investing in 2025, but for long-term minded investors that are subscribed to this passive investing approach, we're pretty relaxed, because overall we don't have to think about what the market might look like in the next 1 or 2 years. We can sit back and think about where the market's going over the next 10 or 20 years. And to be honest, it's these statistics we've spoken about in this video, which is the fundamental reason why passive investing has become so popular today. There's a pretty crazy statistic that these days more money is held in passive investment products than in actively managed products. Quote, passively managed mutual funds reached a combined 13.29 trillion at the end of December 2023, nudging above the 13.23 trillion held in active assets, according to Morningstar. People are waking up, these products are becoming more accessible, and it's a way of investing that sets you up for the long term, but you don't really have to worry about the day-to-day happenings over on CNBC. So overall, I hope this video answers the question of whether we should be avoiding ETFs in 2025. No. But one thing I wanted to cover before I signed off is also just to say that not all ETF products are necessarily the same. For example, as ETFs themselves have grown in popularity, we've also seen the rise in thematic ETFs. And thematic ETFs are not, say, your S&P 500 tracking ETF. They're in fact a basket of stocks that are trying to achieve a different kind of outcome. For example, you might have a Bitcoin ETF that tracks Bitcoin. You might have a healthcare ETF that is a basket of healthcare companies. You might have a bond ETF that holds bonds. As ETFs grew in popularity, these ETF providers obviously wanted to cash in, so they started offering ETFs for absolutely everything. But the problem with that is that many of these ETFs are not at all associated with that passive investing strategy that we've been talking about. So the last thing to say on the topic is just to really remember that ETFs gained popularity because passive investing and market tracking through dollar cost averaging worked really, really well. They didn't gain popularity because they just let people bet on stocks in a new way. And it's worth remembering that if you start to delve into these thematic ETFs, you are definitely taking a step away from that passive investing market tracking strategy, and you're going back to active investing, a strategy which, as the data suggests, typically underperforms. Now, of course, I'm not going to tell you what you should or shouldn't do with your money, but it's definitely a consideration to make, and it's a trap that many passive investors are now starting to fall into because of the success of ETFs and now the widespread availability of them. There are now thousands and thousands of ETF products out there, whereas really all you need is probably like 10 ETFs in total, like in the whole world. In fact, you could make the argument you could probably get away with one if it was just the S&P 500. But with that said, guys, that is my update to ETF investing in 2025. I hope you enjoyed it. I want to say again, thank you very much to Stake for sponsoring this video. If you're an Aussie and you're interested in getting started with that dollar cost averaging strategy, obviously Stake has those features available for you in the app. So definitely worth checking out. If you use the code NEWMONEY, or if you just sign up using the referral link down in the description, that will help you out as well. And it would also help me out. So I very much appreciate it. But with that said, guys, leave me a comment. What do you think of the passive investing strategy? What do you think about buying ETFs in 2025? I'd love to hear your thoughts as well. And with that said, I'll see you guys in the next video.
What the